Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good day, friends. Ira Epstein of Linn Associates with your agriculture update for this Wednesday, the 16th of May, 2018, and we're about 1:40 p.m. Central Daylight Time. Do want to remind you all before we get anywhere going here that we're having our live webinar tomorrow. That's Thursday, May 17th. Remember, it's easy to attend. I've already sent out the invites. I'm not sending them out again. So if you got them, take a look in your regular inbox, your clutter, junk. It went out again today, or you can always call my staff at 866-973-2077. Click up here if you're watching me on YouTube. It'll take you to www.iraepstein.com/webinar, another way to get to it. We'll start right at 12:30 p.m. Central Daylight Time. Bring your questions. In the grain market, beans down another 19 cents. They're getting the heck beat out of them right now. We need to see if China's going to do a trade deal with us or not. And so far, we're far apart. You don't hear a lot about it, but what I am hearing, we're quite far apart, and I don't know what that means to get a grain deal done. Corn down a fraction. Sugar acts like a market that is tired of going down. I don't know if that means it's ready to go up. And when we look at the interest rate futures, you know, you're over 3% on your 10-year yield, and we're not getting any retracement. So maybe the market's going to go to 3.2. Got up just about 3.1 now. Let's take a look, if we could, at some of the chart action and get a feel, though, for what is going on. There we go. I knew that would take place eventually. You ever see these cameramen get in trouble? The weatherman? You've gone from 1054, as you know, back down into this 999 area, and you're just sort of sitting here right now. You've got downside bias. The market's still marching lower. You can almost see it physically. You stop, come down, you stop, you break out to another low, and the pattern has been one of lower highs, lower lows, which is bearish. That now shows you another area that's a problem for the market. Notice how the 18-day and the 100 are converging on each other. You could get what's called a bearish crossover as the 18 gets under that 1028.5, which says that more bearish power is coming to the market. The problem for the bears is the downside target. If you look at today's low, you got to 998 3/4. The Bollinger Band bottom is 996 1/4. So we're at that point where the pros might take some money off the table the way they did when you hit the Bollinger Band here. Then you rallied back up. You hit it here. You rallied back up, and now you're challenging it one more time. If we take a look at the slow stochastic study, notice how the numbers are laying under 20. Both numbers today are under 20. Let's go to the day before, if I could. There they are. I'm going to take you back actually to Friday. There's Friday, both under 20. The day before, they weren't. So we have Friday, both under 20. We have Monday, both under 20. Tuesday, not so. Today, back so. What does that mean? Oversold. So you don't have an embedded reading. You have an oversold condition. So I would expect to see some profit taking hit the market. In the meal market, we have a pattern of lower highs, lower lows, bearish. Until you take out 390.90, I would expect to see the sellers still step into the market with a caveat. The market's already oversold. I would not be surprised to see sellers looking to grab money off the table at this point. In the soybean oil market, you've got that pattern of a lower low, higher high, momentum turned down, no trend. The market did spend about 4 days over. The 18-day average did not have the power to get to the Bollinger Band coming down. It's a market that finds it easier to break than rally. That's pretty evident. In the corn market, battleground to me seems to be this 18-day average of closes. If you take out today's low tomorrow, because the market still has downside momentum, I would think the next target is that last break low that you had at 394 1/4, and from there possibly the lower Bollinger Band. In the wheat market, the pattern has been one of a higher high. You can see that on the swing lines as that high is higher than that one. Straight down break. Market didn't have the power yet to get to the 100-day average, and it might not. You are oversold. As you get into these oversold conditions, markets start running out of the selling power, and that's the thing you have to always be careful of. In the sugar market, we've done a couple of things. Today's rally got over 11.59. So you've broken the pattern of staying first off with the lower highs, lower lows, and second, you closed over the 18-day average. The last time you did that was at the beginning of March. So I put some significance to that. At a minimum, the market's run out of selling. I don't know that the market's ready to embark on being bullish because it's got a pattern of a lower low and a higher high, but momentum is up. Bias is up. We have not challenged an upper Bollinger Band, if you take a look here, since literally the first of the year. If you do, that tells you something that the market might have run out of all the selling pressure in it. In the coffee market, we are still with a pattern of lower highs, lower lows that is bearish, momentum oversold. The question is, do you have the power to get to the lower Bollinger Band? But I would think the shorts are looking to do some covering there, but that doesn't change the overall pattern is bearish. In the cocoa market, you've had a pattern of a higher high, a lower low. Now today you come roaring back, and I'm not surprised at 27.30 because you closed under the lower Bollinger Band. I'll take you to that yesterday. First day under it, couldn't stay under it. So now I'm going to look for resistance up at the 18-day average. However, oversold condition, downside bias without a trend. In the cotton market, here too, you've got a market that made lower lows and a higher high in a pattern that is oversold. It's, in my opinion, a market that is just churning, looking for direction. What's the next move going to be? In the cattle market, another day under the lower band. Now, you were going somewhat sideways, as you can see here. Is that enough to propel the market into embedding? No. It can drag it lower, but these indicators are lagging. So in this particular case, rather than price momentum leading the actual price of the market, price is leading the momentum. So you've got a group here that got caught, and I think it's a bailing action. 2 days under the lower Bollinger Band, you could get short covering, but I don't see anything to change the overall bearishness of the market. Same in the feeders. Look at how you're just running down here in a market, and look at the different pattern. Here at least you got both numbers under 20, the first day of doing that. But again, getting ahead of itself. You broke out of that sideways action. Nothing friendly on this chart. And in the hog market, should you take out 74.07, that could get the bears excited because you could then end up with lower highs than a lower low. So what do the bulls have to do? They have control of the market right now. They have to defend the market, anything around that 74.80 level, and if it gets under that level, could be a real problem for them, putting back into play the lower Bollinger Band. But we'll talk about all this as we get into our webinar tomorrow. I look forward to seeing you all. You have a good day, and I'll talk to you tomorrow.